Good afternoon, and welcome to the February 12th edition of Office Hours presented by the Maryland Center for Collegiate Financial Wellness. My name is Dr. Tisa Silver Kennedy. I'm the founder and executive director of McFew, and I thank you so much for joining me today. Before we get into the questions that have come in from our community, I just want to give you all a bit of background on the center, as well as a disclaimer about office hours and the information that you're going to hear, and then some updates on some more timely issues that have come up, in addition to the questions that have been submitted from our viewers and our community members. So about the Maryland Center for Collegiate Financial Wellness, we call it the Center or McFew. It was founded in 2021 with a vision for all college and career school students in the state of Maryland that they'd be able to achieve these 6 pillars of collegiate financial wellness. Those are being creditworthy, ready, resilient, empowered, successful, and thriving. If that sounds like a mission or a vision that you'd like to support, please do visit us online at mccfw.org. Again, that's mccfw.org. And if the information that you have gleaned from office hours or any of our other programs has been helpful, I encourage you to join our mailing list or make a tax-deductible donation at mccfw.org/support. All right, now let's move on to a quick disclaimer. Office hours is presented for informational purposes only. The information presented during this broadcast does not constitute personal or legal advice. We do our very best to give you the most up-to-date information about student loans and tools to help you navigate them. However, we're in an environment that is very fluid right now. So we're, watching the news, taking stock of things, and we're here to report to you what we know at the time. So again, this is not something that you should take and, totally base your decisions off of what you hear in office hours. You should take a look at your household circumstances, your lender, your services, your loans, your preferences, all of that, combined with information from reliable sources such as office hours, and then put all of that together to make the decision that makes the most sense for your personal circumstance. All right, now that that's out of the way, I just want to give a few updates before I get into the questions from our community. I do want to thank the University of Maryland School of Medicine for inviting me to speak with some of their students earlier this week about repayment and giving an update on current events, as well as the University of Maryland. Last month, they hosted CareerCon, and it was really good to be on campus and talk to the career services professionals about public service loan forgiveness and how they can get on track and stay on track for that. And thank you to my partners at CQ for making that connection to allow the center to be represented that day. On the advocacy front, I wanted to share that I was able to testify yesterday virtually before the state legislature about a bill, HB 611, which is to make sure that schools provide information about student outcomes on their websites in a prominent space so that prospective and current students can view that information and hopefully make more informed decisions about their own higher education journey. So thank you to Delegate Sarah Wolek for sponsoring that bill, and we'll see how it moves. And I will be testifying again tomorrow in support of HB 795, which is a public service loan forgiveness awareness bill. This bill would make it so that employers have access to reliable information about PSLF. That information is created by the State Student Loan Ombudsman. It also would compel employers to verify employment when employees submit a PSLF application, regardless of whether they think the employee qualifies or not. And the third thing it would do is to make it clear for adjunct faculty members on how they are to earn credit toward public service loan forgiveness by enacting a multiplier. So I'm really excited about that bill. This is actually our third session that we've supported it. Hopefully the third time will be a charm, and this bill will make it through to expand access to public service loan forgiveness to even more Marylanders. All right, a couple of other things. In terms of the borrower end user experience on studentaid.gov, we have seen a few things that are a little unusual. I'm thinking about one borrower meeting that I had earlier this week where the borrower logged in, we got to the dashboard, we were able to see their PSLF count for a couple of loans, but when we went to look at the loans in detail, it said you have no loans or grants, and the screen was blank. We went to a bunch of different places trying to get the loan details, but not everything was where it usually is. And the person definitely had not been approved for PSLF. So they still have loans. It's just that the loan records look different depending on what screen we were on. And it was confusing. So we're going to meet again in about a week and see if that issue has been worked out. But right now, if you're going into studentaid.gov and things are looking a little quirky, you are not alone in that experience. And we'll talk in answering some of the questions that came in about some of the other things that we're seeing in studentaid.gov that are causing people to have to kind of look in different places to piece together information about their loans and the status of their loans. The next thing before I get to our first question that I wanted to mention is that someone reached out to me and asked me about FERPA. I have the inquiry in my phone. I will do my best to think of this off of memory because can't find it right at this moment. But they asked me basically if they should, I found it, bear with me. Okay, so it says, it has come to my attention that my personal, educational, and financial records have been improperly accessed by unauthorized third parties. This constitutes a gross violation of my federally protected privacy rights and nullifies any enforceable loan agreements under federal law. And the person was asking me if this is a legitimate way to file for student loan cancellation. So I want to say that at the face of it, I don't think that it's a viable path to cancellation, but you never know. The reason why I lean towards saying that it's not a viable path to cancellation is because it sounds like this is leaning on something called FERPA. FERPA is basically a set of rules that schools and educational agencies and parties that have access to student and parent information regarding, financial aid and student loans. These are rules for how your information is supposed to be treated and your privacy is supposed to be protected. Now, FERPA violations can happen. In the past, FERPA violations have not resulted in any type of compensation, whether that's some kind of settlement that provides cash relief to people that were affected, or the cancellation of their student loans. There's also been nothing that I've seen of a penalty that's assessed for the offender in the case of a FERPA violation, or, like I said, any relief that has been provided for the offended, someone who has had their privacy violated with a FERPA violation. All of that to say, you can sue. You could get together and sue. There's nothing to stop you from suing. There's just no precedent, that any lawsuit involving FERPA has resulted in a monetary reward or a benefit like cancellation. I believe that if you feel your privacy has been violated, because some people have access to records that they didn't have access to a week or two ago, and your information might have been seen by parties that you don't agree with having access to that information, please use your voice, advocate. This is where you should definitely send emails, letters, or call your senators, your representatives, to let them know that you don't agree with what's happening and you want them to do something about it. You should definitely advocate for yourself. You can file a complaint with the Department of Education. There's a privacy office there. Your state also has an attorney general. I know in Maryland, our attorney general has I believe the division is called the Consumer Protection Division. There are multiple outlets for you to file complaints. And if you don't agree with what's happening, then you should file a complaint so that your voice can be heard. I just don't want anyone to get their hopes up at the prospect of having their loans canceled because of their disagreement with the disclosure of their information, or even if there is a FERPA violation. So all of that to say, advocate for yourself. If you don't agree with something, if you do agree with something, send some confirmation to let people know that you feel positively as well. But just as a path to cancellation, I haven't seen anything thus far to indicate that a FERPA violation would entitle someone to loan cancellation. All right, so let's move on to our first question. That question is, will I be able to receive the happy email? I got a feeling this refers to public service loan forgiveness. So let's take a look at the background and see exactly what this borrower is talking about. All right. Says, I'm following the news, and with all the new administration's changes, should I stay working as a public servant, or will PSLF be disbanded before my last 2 years of payments? So, first part, should I stay working as a public servant? That is a truly personal decision. I think that you should remember that where public service loan forgiveness is involved, you don't have to stay with the same employer the entire time. You can move from one employer to the next as long as you stay in the realm of overall public service, which includes government from the federal level all the way down to local or tribal agencies, plus certain types of nonprofit organizations. So you have a lot of options within that realm of public service that would still keep you on track for public service loan forgiveness. As for the second part of the question, will PSLF be disbanded before my last 2 years of payments? I can't say. I can say, though, that PSLF is a federal program that was established by Congress in 2007 as a part of the College Cost Reduction and Access Act. This is important because when something is created by Congress and becomes law, it's harder to undo the law than it is to undo something that came about by way of executive action. So as an example, I don't know anyone who hadn't heard about the Biden-Harris administration student debt relief plan that was going to provide up to $20,000 worth of direct relief to eligible borrowers. That program was contested in court, went all the way up to the Supreme Court, and the Supreme Court ultimately blocked it. It was easier for the legal challenges to attack that particular initiative because it was not law. It was something that was proposed by President Biden and his team, and that made it more susceptible to legal challenges. So it was deemed illegal. It didn't happen. The Biden-Harris administration put forth other proposals too, and some of them were fought all the way up to the highest court. Things are paused. A lot of this can happen because the actions were from the executive branch. PSLF is not like that, though. PSLF was, again, created by Congress, signed into law by President George W. Bush. So Congress would have to act in order for PSLF to end. I don't know that that would happen. Anything's possible, but I don't know that that would happen. And I haven't seen anything, immediately to indicate that it is happening. I can say that PSLF has been, a subject of debate for years, but there's never been any agreement reached. And truly, it hasn't been, from my view, a priority for attack. So I'm not sure what will happen, but just know that PSLF is not one of the programs that could be eliminated or struck down in the way that those executive proposals have been recently. All right, let's take a look at another question. This one's also about PSLF. It says, my PSLF count doesn't make sense. I'm tempted to say join the club here, but I'm going to go ahead and get some more background before getting into a detailed answer. So this person has 15 loans. Their PSLF tracker has different counts for each loan. 2 of the loans have a count of 109. The other loans have 69. Consolidation occurred and only 2 loans have a balance greater than 0. That's a really important detail there, that only 2 loans have a balance greater than 0. Because when a person consolidates, and in this case, there were 15 loans, so I guess 13 were consolidated, and now the 2 loans that are left over are the consolidation loans. Those loans are the only ones that have a balance greater than 0. Only a loan that has a balance greater than 0 can qualify or be eligible for PSLF, because PSLF does not apply to loans that have already been paid off. And if you consolidated the loans, that means your old loans were paid off and a new loan was originated. Also, it says 2 loans have a balance greater than 0. When you consolidate loans, the term consolidation is usually bringing everything all together into one loan. However, with federal student loans, if you have both subsidized loans and unsubsidized loans in your original portfolio, when you consolidate those loans, the consolidation loan comes out with 2 pieces. One piece keeps all of your subsidized loans together. The other piece keeps all of your unsubsidized loans together. So it's very possible, and for pretty much everyone I know, Once you consolidate, you have two loans. One is the unsubsidized portion, one is the subsidized portion. So in this case, the person has two consolidation loans, and both of those loans have a balance greater than zero. So with the payment counts, we've been seeing some evolving conditions, I'll say, with payment counts. What we're seeing as of late is that even after a person consolidates, we can see payment counts attached to the loans that have already been paid off. And believe it or not, this can be a good thing. I say that it can be a good thing because after, I think, July 1st of 2024, that's when we shifted to this model of a weighted average being used to assign a PSLF qualifying payment count to a consolidation loan, if that consolidation loan included loans with differing amounts of repayment history. So in this case, the borrower said some loans had 109, some had 69. If these loans were consolidated together, the qualifying payment count on the consolidation loan would be based on the weighted average of the 69 and the 109, depending on the balances of those underlying loans. So whichever types of loans had the largest balance, those would carry more weight in the formula. So if you know you've got some loans with 69, some loans with 109, the qualifying payment count on the consolidation of those loans would be somewhere in between 69 and 109. Where it gets tricky is that some people are seeing these different payment counts and thinking that these are active. But truly, the only payment counts that matter are the ones that are attached to a loan that has a balance. So if you're seeing payment counts for loans that have been paid off through your consolidation, it's good that you have those numbers, because you can go back and you can check the math to see if the weighted average formula has been calculated correctly. So it's actually a good thing to be able to see the individual payment counts attached to each of your older loans. But keep in mind, the only qualifying payment count that matters is the one that's attached to your loans that have a balance. So in this case, this would be the two consolidation loans that are left. Check the qualifying payment count on those two loans that have a balance, and that lets you know where you stand relative to the 120 payments that you need in order to have the debt cleared by PSLF. So the good thing is the Department of Education is counting qualifying payments on each of the individual loans, but depending on the time that you see it, your payment count for that consolidation loan might not look like it's all the way correct. So give it a little bit of time, and once every single loan has been considered and that weighted average formula has been run, then that number of qualifying payments will be attached to the consolidation loan, and you'll know exactly where you stand. All right, that was a great question. All right, next question. Am I eligible? Definitely going to need some details on that. So let's go to the background. It says, I consolidated my loans and applied to have them counted, but never heard back before the transfer. And I'm trying to figure out if old payments count. I'm currently in forbearance because I stopped working last year. I want to re-up my IDR plan, but I'm not sure where to start. Let's take a look at the answer. So to get to this answer, we need to ask a couple more questions. The first one is the payment count. The first one is, did you receive your PSLF or IDR count? Do you know where you stand relative to the forgiveness milestones? The payment count should be viewable on your dashboard after you log into studentaid.gov. If you've applied for PSLF before, the PSLF, that tracker should pop up at the top of your dashboard once you get in. The second question is, have you returned to work for an eligible employer? You can determine if your employer qualifies by using their employer ID number. You want to go to studentaid.gov/PSLF, search for eligible employers by putting in that EIN to make sure your employer is one that is eligible. As far as the IDR plans are concerned, you can manage and apply for an IDR plan at studentaid.gov/IDR. I will say that once you get there, you'll notice that there is some language about, the potential for your payment estimates to not be accurate. There's also information about the save, forbearance, and the injunction that's affecting the IDR applications. But you can start the application online. What we have observed is that you are unable, or at least we have not been able, to have anyone make it through the application successfully with an electronic transfer of their income information from their tax return. Everyone has had to have paper documentation and upload that documentation in order to get through the IDR application. All right, so to fully answer the question, to remain eligible for PSLF, you want to make sure that you are enrolled in a qualifying repayment plan, and all of the income-driven repayment plans qualify, and you want to make sure that you stay employed with a qualifying employer, making sure to meet that 30-hour per week on average threshold. All right, let's move on to the next question. That is, what is happening? Should I still be planning on working towards IDR forgiveness? Oh, there's a lot happening. Let's get into it. Just for some background, this person consolidated in April of 2024 before one of the IDR adjustment deadlines. Their consolidation took place during the SAVE injunction. That's where all loans that were enrolled in SAVE were placed into or forbearance, a non-interest bearing forbearance. The person does not qualify for PSLF, so they're looking for forgiveness by way of income-driven repayment. As far as their income is concerned, it's less than their student loan balance, so the IDR formula should give them a payment option that is perhaps more affordable than the 10-year standard plan. And when they log into studentaid.gov, they do not see an IDR payment count. So let's take a look at the answer. First question we had to get to the answer is, what repayment plan are you enrolled in now? Are you currently enrolled in one of the IDR plans? Right now, from what we've seen, the only income-driven repayment plan for which forgiveness is currently moving forward or allowed to move forward is IBR, which is income-based repayment. I know that this can get confusing with all these acronyms, but just think of IDR as the umbrella, because IDR is a type of repayment plan. And then under that umbrella, you have the different plans, such as income contingent repayment, income-based repayment, pay-as-you-earn, revised pay-as-you-earn, SAVE. So all of those plans fall under the umbrella of IDR. All IDR plans have a cancellation provision within them. It's just that because of the SAVE injunction, the forgiveness has not been allowed to move forward at this time for every other plan except for IBR. So IBR is the one income-driven repayment plan that's still allowed to move forward. You can use the loan simulator to see if any of the income-driven repayment plans make sense for you. But to keep on earning credit toward IDR forgiveness, you need to be enrolled in an income-driven repayment plan. SAVE is an income-driven repayment plan, but it's just on hold right now. So IBR is the safest bet. If you don't have the IDR payment tracker, you are not alone in that. I can't see the IDR payment tracker on my own account. However, I looked around in some other places and I was able to find a payment count. So if you go to studentaid.gov, log in, get to the dashboard, and you are not able to see a payment tracker there, on the right-hand side, let me just show you a picture of this. It's much easier this way. All right. On the right-hand side of the dashboard, you should see a box. I think it says interested in learning more about income-driven repayment. And if you click on that Learn More button, it should take you to a screen that shows you your progress toward IDR forgiveness based on two plans, SAVE and IBR. Now, IBR is the only plan for which forgiveness is allowed to currently move forward. Every other income-driven repayment plan is tied up in this SAVE forbearance. But when you take a look at this page, they're going to show you your progress under the conditions of SAVE and your progress under IBR. And in this case, you'll see that for SAVE, the borrower has 75 out of 228 payments. And then under income-based repayment or IBR, they have 75 payments out of a required 300 payments. This is good to know because it gives you a status check. It lets you know how close you are to those IDR cancellation milestones. But unfortunately, because of the SAVE injunction, any loans that are enrolled in SAVE right now are not making progress toward that cancellation milestone because the loans have been placed in a non-interest bearing forbearance. And this is why a lot of people want to know, should they switch out of SAVE so that they can get on track and keep earning credit toward IDR forgiveness? And I think that might come up in one of our later questions. So let's go to the next question. This one is about PSLF. It says, didn't the Department of Education take over from Mohela for PSLF? Kind of. I'll explain to you in detail. But first, I want to give the background of this borrower's situation. It says, my spouse's loan is under PSLF and SAVE. She has been dealing directly with the Department of Education for any questions, and she logs into their site to review her loan and PSLF count. She was with Mohela and then was switched over in May, we assumed, due to their inability to deal with PSLF. Is studentaid.gov now her servicer? And if not, who is? This is a great question in reference to a fairly recent change in processing. So the answer is the Department of Education is the lender, not the servicer. The servicer is the party that you deal with for basic concerns, such as sending in a payment or making an online payment. They also send you bills. They handle customer service questions. So think of the servicer as the kind of a middleman between you and the lender. Prior to last summer, there was only one servicer, like this borrower mentioned, that was responsible for managing the PSLF process, and that was Mohela. That changed last summer. There was a processing pause for May, June, and about half of July. And during that time, the Department of Education shifted its model. No longer is Mohela the company that is responsible for PSLF and the customer service experience with PSLF. The Department of Education's website, through studentaid.gov, they have absorbed that end user PSLF experience. So when you log into studentaid.gov now, you'll see if you've applied for PSLF before, your progress tracker is right at the top of the dashboard. Everything related to your PSLF application is now inside of studentaid.gov. So you don't have to go to mohela.com anymore. For PSLF, you want to go to studentaid.gov. This doesn't mean that you still shouldn't be in touch with your servicer, because payments are processed through your servicer's website. So if you want to make a payment, you would go to mohela.studentaid.gov. If you want to check on the progress of your PSLF application, you would just go to studentaid.gov. So Ed is the lender, Mohela is the servicer. The servicer is responsible for basically bill collection, everything related to you sending your payments. The Department of Education is the lender, but they also house this PSLF process within studentaid.gov. Something the borrower also said was, did Ed take this over from Mohela? Mohela is still involved. There are multiple loan servicers that are involved in the PSLF application process, but as an end user, you are going to use studentaid.gov to submit your PSLF applications, to check your progress, to receive correspondence, and that's where your congratulations email or letter will come from as well. So great question. And if you're not sure, for anyone else who's wondering who their servicer is, if you go to studentaid.gov and take a look at the dashboard, there's a section called View My Loan or My Loan Servicers, and you can go there and take a look and find out who your servicer is or servicers are if you have more than one. All right, let's move on to the next question. That is letter saying rejected after letter saying I was in forbearance. Two different submissions. So definitely have some background to cover on that. I submitted back in December through FSA for SAVE to IBR. Before I go on with the rest of this, just want to translate the acronyms here. FSA is Federal Student Aid, so they probably submitted this application through studentaid.gov, and the purpose of the application was for them to switch out of SAVE and into income-based repayment. So they wanted to change repayment plans. All right, now it says, I heard nothing after 45 days, so I resubmitted the wet signature. Within 5 days, I got the your loans are switching and in forbearance for up to 60 days message. I just got a letter today that I was missing something and it couldn't be approved. I called Mohela for a 4-hour wait time, but the automated machine said your loans are currently in forbearance. I don't know if that's a save forbearance or a processing forbearance. How can I tell? This is a great question. And because the servicing experience is managed by Mohela, you would have to go to Mohela to get an answer to that question. But we have another question for you, a clarifying question. And that is, when you go into studentaid.gov and view the details of your loan, what do you see for the status and what do you see for the repayment plan? The picture that you see below is from a studentaid.gov account where the person is logged in. They went to My Aid, then view details, then view the breakdown. From there, you can click on an individual loan. Make sure you only click on the loans that actually have a balance, and you can take a look at the details. And in this case, if you look toward the middle, there's a loan status column and there's a repayment plan column. So we can tell that this loan is in repayment, and it's in repayment on the standard repayment plan. So go to studentaid.gov, take a look and see what the status of your loan is listed there. However, if you're looking for information about the processing of your application, you would need to reach out to Mohela, and Mohela does have an option for you to request a callback. And instead of staying on hold for several hours, use that option and hopefully they'll call you back at a time that is convenient for you to speak. Also, just wanted to share some information from the Department of Education's online help center and what it states about eligibility for income-based repayment. The first point is to qualify for pay-as-you-earn and the income-based repayment plans. Your monthly payment must be less than what you would pay under the standard repayment plan with a 10-year repayment period. This is a long way of saying that in order to be eligible for pay-as-you-earn and IBR, you have to exhibit what's called a partial financial hardship. And that just means the 10-year standard plan based on your income, it would make you have a higher payment than what you pay on an income-based repayment plan. Generally, you meet this requirement if your federal student loan debt is higher than your annual discretionary income. So if your debt is more than you earn in a year, then usually the income-driven repayment plans provide a more favorable or a more affordable payment for you. So again, go to studentaid.gov, take a look at the status of that loan. And if you're really interested in continuing to make progress toward IDR forgiveness or getting closer to PSLF, then yes, it would make sense to explore IBR, because IBR is the only plan for which forgiveness is being allowed to move forward. All right, let's take a look at our next question. This is also about SAVE and PSLF. It says, SAVE, Nightmare, and PSLF. Are there any benefits to switching to the IBR plan? Let's take a look. Just kind of breached that subject, but we need to know more about your personal circumstance. We ask for your personal circumstance because income-driven repayment plans use a formula that's based on your adjusted gross income, your tax filing status, and the number of people in your household. And SAVE was the most affordable. For most people, it was the most affordable income-driven repayment plan ever. So some people had really low payments. Some people had payments that were $0. The other income-driven repayment plans use different formulas. So payments are likely to be higher. However, being in SAVE right now means that your progress is at a standstill. It's not moving toward IDR forgiveness. It's not moving toward PSLF. If you are enrolled in IBR, then you could continue to make progress toward those forgiveness milestones. Keep in mind, with IBR and the pay-as-you-earn plan, your monthly payment will never be more than what's required of the 10-year standard repayment plan. Second is that, again, IBR is the only income-driven repayment plan for which IDR forgiveness can currently be processed. And third and finally, loans that are enrolled in IBR are not in the SAVE forbearance, and that can allow you to continue earning credit toward PSLF. Even with all of that, I have to say, I don't know how long it would take for you to successfully switch from SAVE to IBR. So depending on where you are in the PSLF or IDR forgiveness timeline, it might be worthwhile for you to seriously explore that switch and formally apply. But in other cases, if you're close to the very end, If it's PSLF, then you should probably give the PSLF buyback a look, because you might reach the 120 mark in terms of month of qualifying employment and just need to buy back these last few months in the SAVE forbearance. And if you put another application out there to switch from SAVE to IBR, I don't know how long it would take for that to be processed. And you'd still want to recapture the month that you've missed from the SAVE forbearance. All right, let's move on to our next question. That question is shifting gears to the pre-college and current college students. It says, my children have a 10+ year gap. I know we need to do the FAFSA. What's going on? Well, a lot has changed in the past 10 years when it comes to FAFSA. Most of it has been in the past couple of years. So let's talk about what's going on. A bit of background first. I have 2 kids, and if I'm honest, my oldest child did all the work for herself. I just reviewed what she completed. My youngest child is different. My daughter, who is the eldest, will help, but she says this process looks different than she remembers. And she is correct. The process is definitely different. The parent does have an FSA ID. That is the ID that you need to get into studentaid.gov to complete a FAFSA. The student does not have an FSA ID. The student is currently a junior, and the parent has not filed their 2024 personal income taxes yet. All right, let's get to the answer. The good news is, with a child that is a junior, you still have plenty of time and you are ahead of the curve in terms of submitting the FAFSA. The FAFSA usually, it's supposed to become available October 1st of every year. We've had a couple of delays in the most recent 2 cycles because the FAFSA went through some significant changes. But this year, we're expecting the FAFSA to be back on track and released October 1st. So you want to make sure that your student creates an FSA ID, and they can go to studentaid.gov to create that account. When they set up their FSA ID, your student needs to have an email address that is separate from the email address that you use to set up your FSA ID as a parent. And they'll also need to have their social security number. Another good idea is to set up a shared email account that you both have access to just for this college selection and financing process. With the FAFSA uses information from 2 tax years prior. So if you haven't completed your 2024 taxes yet, that's okay. A lot of people haven't. It's only February. But for the 25-26 year, you will have needed to have filed your 2023 taxes. And also with the 2024 taxes, definitely want to get those in and get that in prior to the October 1st release date for the FAFSA. And this is for people who are just new to the FAFSA. Students and contributors will have to approve the Department of Education, give them permission to pull your federal tax information. So instead of trying to enter things manually, you can use the option to transfer your information over. And that also can help keep things more accurate, because when what you input or what you enter into the FAFSA doesn't match your records, like your tax returns, that can cause flags that prevent your FAFSA from being fully processed, and that can prevent you from being generated an offer. And that makes it difficult to make a decision about, which school you want to attend or how much it's going to cost you. So do your best to complete the FAFSA as early as possible and as accurately as possible, and good luck. All right, let's move on to our next question. That is, what about student loan interest rates? Okay. This person, just a bit of background. It says, I'm trying to plan my financial impact for college for the next 4 to 6 years if I decide to go to graduate school. Do my interest rates stay the same for the time I am in school? So there are 2 components to the interest rate discussion around student loans. The first one is that once you have a student loan, the rate on that student loan is fixed for the lifetime of the loan. That's never going to change. So a student loan is not, student loans now are not adjustable rate loans. Whatever rate your loan was dispersed with, that will be the interest rate for the lifetime of the loan. If you decide to do auto debit and let them automatically pull your payment out each month, you could get an interest rate cut. But aside from that, the interest rate on your federal student loan is fixed. However, every year, the interest rates for student loans for the coming year, those rates are determined. So if you took out a loan for 2024-2025 academic year, chances are the interest rate on loans taken out that year will be different from loans taken out for the 2025-26 year, and are different from the rates taken out in 23-24. So every year, interest rates for the next year are determined. But once the interest rate is set, that is the interest rate that's fixed for the life of the loan. So the current interest rate, this is for loans that are dispersed between July 1st, 2024, and this would be from July 1st, 2024 to June 30th of 2025. The interest rates are as follows. For undergraduate students, both subsidized and unsubsidized loans have a rate of 6.53%. For graduate or professional students, they're only able to take out plus loans or unsubsidized loans first and then plus loans. For the unsubsidized loans, the interest rate is 8.08%. For plus loans, these are loans that can be taken out by graduate and professional students as well as parents. That interest rate is 9.08%. So the undergraduate loans have lower rates. The graduate, professional, and parent loans have higher rates. But once you have a loan, your rate is locked in for life. Now, because interest rates change every year, just wanted to share some historical information for you. These are some old interest rates on subsidized loans and unsubsidized loans going all the way back to 2006. So if you want to know, historical rates, because rates were fixed, for quite some time, year to year, the rate did not change. They were fixed for quite some time, but then things changed. If you'd like to take a look at the historical rates, you can go to studentaid.gov and take a look at those trends. All right, let's move to our next question. This is actually our last question. It is, I have a considerably high balance. Can I attend school? Definitely need some clarification on this, because this could be referring to a loan balance, or it could be referring to an institutional debt. That is a debt that is basically like an outstanding balance owed to a school, not the federal government. So for background, yes, I have an $8,000 balance from the fall 2024 semester. Classes were dropped due to non-payment. My school's add drop period has passed. There are no mini semesters or accelerated semesters. The student has no Parent Plus loans on file or a denial, and the student is also a Maryland resident. So this is an institutional debt, a debt that is owed to the school, like a past due balance. And unfortunately, when you have a past due balance, it prevents you usually from registering for the next semester. And since this balance was not paid off before the registration deadline, the student has missed the opportunity to register for the spring 2025 semester. Before you're able to proceed at your institution, the bill is going to have to be paid. So you've got to come up with a manageable plan for taking care of that fall 2024 bill. And if you go back to school, you got to have, or it would be very helpful to have a plan to make sure that the bill is covered each semester going forward, because it can get very expensive with the time and the money to enroll and then have your courses dropped and then have to pick up again. And depending on when you drop, there could be a different level of financial responsibility that you have for the outstanding bill, or to pay back certain forms of financial aid if you receive them. So put together a plan before you try to go back to school, and make sure that you include all sources of funding in that plan, including the Maryland Higher Education Commission, since this person mentioned that they are a Maryland resident. MHEC, I believe, has more than $100 million worth of state scholarships and grant programs that the commission manages. And as a Maryland resident, you may be eligible for some of those grant funds. So take a look at MHEC, make sure you set up an MD CAPS account, and develop your plan to tackle that bill and get on a firm footing with a plan for how to keep the bill paid and stay in school when you're able to return. All right, so that does it for our questions. I'm checking social media. I want to thank 1920s Strivers Row Flow for joining us on Instagram. And thank you for the engagement. I do not see any questions. I want to go ahead and wrap things up by sharing a resource for Marylanders, and that is the Student Loan Ombudsman for the state of Maryland. Maryland is a state that has a dedicated student loan ombudsman housed in the state's Department of Labor. If you are having problems with your student loan servicer, and you have worked with them to try and resolve them and you just haven't been able to arrive at resolution, this is the point where you should engage a third party to join in and advocate for you. And that's where the student loan ombudsman can be very helpful. The ombudsperson can assist with issues including failure by the servicer to communicate with the borrower, errors in crediting principal and interest payments, misapplied payments, inaccurate interest rate calculations, billing errors, loan consolidation or modification errors, and or inappropriate collection activity or tactics. So you can go to the state's Department of Labor, find the Student Loan Ombudsman online, and submit a complaint to get their assistance in bringing you closer toward resolution. All right, so that does it for today's edition of Office Hours presented by the Maryland Center for Collegiate Financial Wellness. If you have a question that comes up after the broadcast, please do reach out to us at mccfw.org/contact. That's where you can submit your questions. You can also engage with us on social media. We are at the MCCFW on X, Instagram, and Facebook. And also, please like and subscribe to our YouTube channel at the MCCFW. Now that this broadcast is coming to an end, we will go back and annotate the episode and upload it to YouTube so you can get straight to the content that matters most to you. Again, I'll check social media just one last time to see if we have any questions that are coming up. Nope, I see none. So I just wanted to say before we go that, as always, I appreciate our community for sending in questions, because if you have a question, chances are there are a lot of other people out there who have that question and just haven't asked it yet. So thank you so much for submitting the questions. Also, just generally, there's a lot going on right now, and there are a lot of news pieces. There's a lot going on, and there's a lot of information flowing. I just want to give everyone a general reminder to be deliberate about the sources of information that you use, especially when it comes to your student loan debt. Your lender is the primary source of information because they're the ones who you owe the money to. Your servicer is another source of information about your specific debt. Beyond that, just be careful about the headlines, the social media posts, because a lot of them are designed to grab your attention, but not necessarily provide you with a solution or a solution that is applicable to your situation. They're designed to get traffic. So please just develop, if you can, a list of reliable sources that you turn to for information so that you're not, riding what can feel like this roller coaster, that goes along with the headlines about what could happen or what might happen. Just manage what you can, control what you can. And that's what is happening right now with you. So keep that in mind. I wish you all well. And it's always my pleasure to be here and share with you what I know at the time of this broadcast when it comes to student loans. So thank you again for your engagement. We appreciate you. I'll say one more time, like and subscribe. We're on YouTube as at the MCCFW. And until next time, be well.